Good morning. My name is Gary Mailer. I am the Executive Director of the Texas Real Estate Research Center. Welcome to our fourth in a series of real estate focused conferences with the Dallas Federal Reserve Bank of Dallas. We've enjoyed a vibrant relationship with the Dallas Federal Reserve for many years. Today, we have a truly robust lineup of speakers and topics for you. And at this time, I would like to introduce Joseph Tracy. Joe is the Executive Vice President and Senior Advisor to the President of the Dallas Federal Reserve Bank. He's widely recognized as an impeccable research leader. He has previously served as the Executive Vice President of the Federal Reserve of New York, and he also taught at Yale and Columbia. Please welcome Joseph Tracy. Joseph, the program is yours. Thank you for being here.
Gary, thank you very much. And good morning to everyone, and welcome to the Emerging Trends in Real Estate Post-COVID Conference. Thank you for taking the time to join us this morning for what I think will be a stimulating 2 days of discussions on key trends in the residential and commercial real estate market. The Federal Reserve Bank of Dallas is pleased to partner with the Texas Real Estate Research Center at Texas A&M University, as Gary said, for our fourth joint conference. This partnership dates back to 2016 when we did our first real estate focused event together. Again, special thanks to Gary, the executive director, and his team for their great support and collaboration in pulling together today's event. We value our relationship with the center, and we hope to continue to collaborate and work together in the future. So the effects of the pandemic over the past 2 years have been felt in every industry, and real estate really was no exception. On the commercial side, vacancy rates in industrial buildings have been driven to record lows, and new warehouses can't be built quick enough to meet the burst of growth in e-commerce activity. In sharp contrast, office vacancy rates remain high, and the sector is still struggling to find its footing as companies reorganize and consolidate office space in response to new hybrid and remote work schedules. On the residential side, home sales recovered quickly during the pandemic and supply tightened considerably, sending house prices to new highs. Some of this reflects a repricing of distance from central business districts, reflecting expectations for reduced commuting days per week. The pandemic also shifted preferences for housing density. Apartment demand was slower to recover, with rents being flat to down in 2020. The multifamily sector finally sprang to life last year, with apartment absorption reaching record levels and rents climbing at an unprecedented pace. This firming of rents is providing additional upward pressure on inflation that the Fed is contending with. This year's conference spans both this morning and tomorrow morning, both from 9 to 11:30 a.m., and will explore varying trends in the real estate sector. Today's speakers and panelists will explore the residential and commercial real estate sectors from both national and local market perspectives. And we'll discuss what's in store for this year in light of rising interest rates, high inflation, fading fiscal stimulus, and the emergence of a new hybrid work model. Tomorrow will feature our keynote speaker, Mark Zandi, Chief Economist of Moody's Analytics, who will provide an overview and outlook for the U.S. economy and how the real estate sector will navigate through post-pandemic crosswinds. Following the keynote, researchers from the Dallas Fed and the Texas Real Estate Center will discuss the impact of pandemic migration on the residential real estate sector and provide some color on the movement of people out of dense, high-cost neighborhoods to lower density, low-cost housing areas. We hope you will be able to join us for both days. The event will be recorded and will be available following the end of the conference on the conference webpage. So the topics of this conference will help inform us on how to best meet our dual mandate of stable prices and maximum employment. As you know, COVID-19 created significant supply shocks that will take time to resolve themselves. In the face of these supply shocks, monetary policy must balance its efforts to support economic growth, but also to maintain price stability. The pace and manner that the FOMC decides to remove policy accommodation will have important implications for the real estate sector. The Federal Reserve is committed to pursuing our dual objectives in a manner that provides economic opportunity to all segments of the population. Policy is informed by identifying and understanding the obstacles to economic inclusion through our research, hosting events such as these to share with the public our expertise and research on the topic, conducting listening sessions across the system, and bringing together business, nonprofits, and government entities to create actionable solutions. So I want to thank you for your attention, and I hope the conference proves both interesting and valuable to you as well. I will now turn the event over to my colleague, Leila Assani, so that we can get started with the first panel. And I hope you have a good day. Thank you.
Thank you, Joe. Good morning, everyone, and welcome once again to the first panel of our conference titled Emerging Trends in Real Estate Post-COVID. I'm Leila Assani, Senior Business Economist at the Dallas Fed. And we are delighted that you have tuned in for our event this morning. The pandemic's impact on the residential real estate sector has been unusual and significantly different than the last recovery. Unlike the Great Recession, home sales are strong, prices are sky high, and apartment rents are climbing at a rapid pace. Housing starts have responded to the strength in demand, but the construction sector is mired in operational challenges, which is constraining building activity and putting upward pressure on home prices and apartment rents. This morning, we have two speakers who will discuss the effect of the pandemic, the current bout of inflation, rising mortgage rates, and supply-side constraints on the residential real estate market, and what to expect in 2022. Our first speaker is Ali Wolf, who is the chief economist for Zonda. In this capacity, Ali manages and analyzes the content for Zonda, runs special research projects, and strategizes with the nation's largest home builders and presents nationwide, covering topics across the housing market and wider economy. Ali is the creator of Zonda's proprietary indices, including the New Home Pending Sales Index and the New Home Lot Supply Index. Highly regarded as an industry expert, Ali is quoted frequently in the national media. She also serves as an advisor to the White House, providing data and insights on the US housing market. Prior to joining the Zonda team, Ali worked for another consultancy firm and was a researcher for both the Canadian and UK parliaments. Our second speaker this morning is Gay Koro-Roton, who is a senior economist and the director of housing and commercial research for the National Association of Realtors. She manages the production of NAR's proprietary housing, commercial, and international statistics, surveys, and research. Her work focuses on the effect of economic, demographic, and industry conditions on the current trends and outlook in the residential and commercial property markets. Thank you so much, Ali and Gay, for being on the panel this morning. Ali and Gay will first present their prepared remarks, following which we will take questions from the audience. Questions can be submitted during the session via the Q&A button, which is located at the bottom of your Zoom screen. So please feel free to utilize if something comes up. With that, I will turn the session over to Ali Wolf for her presentation. Thank you, Ali.
Awesome. Hi, Leila. Thank you so much. And thanks to the entire Federal Reserve Bank of Dallas for having both myself and Gay here today to go through what we're seeing on the ground. Now, as I share my screen, I want to give a little bit of context. We're going to go through the trends that we're seeing for the housing market. We're going to skip the economic update because Mark will be here tomorrow. He'll give some of the thoughts that he's seeing on the ground. We know the backdrop. We know that we have these high level of inflations. We'll talk about how that plays into the housing market. And we also know we're in a very fluid situation. When you look at just what happened this morning, obviously a big humanitarian crisis, some challenges that are happening there that could play into and likely will play into the mortgage rate environment, the economic really backdrop. So keep that in mind as I go through. We're adapting our forecasts and our thoughts as the days go on. So I'm going to set my timer. I got to stay within 20 minutes and we have a lot to go through. So as mentioned, I am Allie Wolf, the chief economist with Zonda. If you're not familiar with Zonda, we're a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Now, my proprietary data here at Zonda is going to come from the new home space. But of course, there's no way to know what's happening in the new home market without knowing what's happening internationally, nationally, with policy, what's happening in the resale market, what's happening in different markets across the country. So I'm going to put together a lot of those thoughts in today's brief presentation. 3 sections. We'll start high level with the basics. Then we'll go into demand drivers. That will be, again, very high level, expect that. And then we'll go into our forecasts and final thoughts. That will be my longest section of today's deck. So starting with the home sales environment. Zonda does a monthly division president survey. A division president would be a leader that is overseeing multiple communities within a certain market or region. And we've been checking with these builders to supplement our data about mid-month trends, what's going on. And we're now in the spring selling season, and we have over 90% of the builders that we're talking to that are saying that the demand is either stronger than they expected or on track with what they expected. And as I go through the comments, it was overwhelmingly positive. We have great start to February, stronger than expected traffic given high interest rates and high prices. Communities that are open have homes available for sale. They're selling really well with continued price increases. So there's a lot of enthusiasm. That's one of the ways I would describe the housing market right now, and also a lot of panic. The panic comes from the idea there are people that have either been wanting to buy homes, but now really aware of what's happening with mortgage rates, and they're trying to jump in. This panic around the mortgage rate environment. And so we're calling this home price urgency, where we know the 10-year has had some fluctuations because of the geopolitical events, but generally we were speaking, last year we were talking about 2.7% interest rates. This year we're talking about almost 4% interest rates. And we'll apply the math to that a little bit later. But for now, what we know is the immediate impact of rates going up is maybe a little bit counterintuitive. The idea that people are rushing into the market because they're afraid that they're going to continue to go up. So that's the mortgage rate urgency, but they also are looking at home prices. When you look at home prices across the top markets in Texas, we're talking prices up between $100 and $350 every single day. And that's causing some of the panic. Prices are going up, interest rates are going up, monthly payment is going up. I want to try to jump in today's evolving market. So take a look at this. This is looking at new home contract sales by price. You can see it's looking over time. In Dallas, in the early days of the pandemic, let's just say 2020, 45% of the contract sales in the new home market were between 200 and 300,000. Look at how the market has changed. I know a lot of you feel it on the ground, but this is the actual data. You can see you go from 45% of the market to about 10% of the market at that price point. Look at the blue and orange lines that are going up. That's the 400 to 500,000 and the $500,000 plus. We've seen the pricing dynamics have changed. The most recent data I've seen is for Dallas, prices are up 25% compared to where they were last year. So there's this increased appetite for housing on top of an already strong demand. And these buyers are finding that the resale market is still incredibly constrained. This is showing you active listings by year, by month. I want you to first look at that orange line. That orange line is showing you active listings in 2021. Go to the January part of that orange line, look below, you see this little dash. That dash is 2022 levels for January, even lower for listings. Houston down 24%, Dallas down 39%, San Antonio down 18%. Now, one thing we have to acknowledge is if you're looking at the sales numbers, they don't completely jive with how low overall listings are. And that's partly because the market is unintentionally being manipulated by the fact that in Houston and San Antonio, we have about 50% of homes that are on the market that are off the market in less than 2 weeks. So that's going to contribute, not fully get captured in those listing numbers, but we know that there have been fundamental shifts. We know people have refinanced, and as they've chosen to do so, they're not moving as much. They're putting some money in remodeling. We know there are investors in the market. We know there are second home buyers in the market. And I think a really fundamental question is, if I sell my home, where else am I going to go to? You find yourself in this prisoner's dilemma. So that's the backdrop on the resale side. And I think an easy thing people say is, well, why aren't builders just building more homes? I think Layla did a good used a good phrase of operational challenges. We'll talk about that a little bit later. When you look at new home community count, community is anywhere where there's 5 or more units for sale. You can see what's happened to those stats. Dallas, Houston, San Antonio down between 11 and 20% in terms of new home community count. Homes are selling out quicker than they can be replaced. Now, consumers, they're trying to buy in today's market, and what they're finding is in Texas, you have 90% of builders that are intentionally slowing their sales. They're throttling their sales, and they're doing it. Let me give some context. Some builders are saying, I could sell 10, 20 homes per month. The demand is there to support it, but I'm going to choose, instead of selling 10, to sell 2, because 2 is supported by the land that I have, the crews that I have, the supply that I have. That's what our production capacity allows. So we know the backdrop is that we're not letting the free market be the free market because we can't right now, because there are these constraints. And so we look at this and the buyers are trying to figure out, how do you navigate? And I want to take the conversation there. Remember, when I go through this section, it is going to be very high level so we can get to that final section on the forecasts. But one of the questions we should all be asking is, what's driving this strength? And anyone that's seen me present before has probably seen what I'm about to show you, but there's a reason I'm showing you again. This is a matrix we put together at the beginning of the pandemic when the market just skyrocketed back and we were like, what is going on? We created this. But to me, this becomes important. It tells us who are the 8 main buyers, first-time buyers, move up, luxury, relocation, these different categories. And why are they buying? Work from home, demographics, great home equity, all these different factors. So we know that was the basis for the strength in 2020. How are these holding up? Well, I would say a lot of them are still supporting growth. Work from home, the fear of missing out. And I'd say a few of them, I'm asking myself, at what point do these tailwinds become the headwinds? We've seen the stock market. We've seen how there's been volatility there. We know rising prices right now are encouraging people to get in. What happens when we start to bump up against that ceiling? And of course, the low interest rates of 2.7 to 4. I know 4 is low on historical context. Well, 4 is not low when you look at how many people have refinanced at such a low level. So you look at those categories. When you look at the new home market in particular, move-up buyers are the most active, then millennials, then relocation buyers. And so I want to go through those 3 categories, starting with millennials. This group, when you look at demographics, they're basically as good as they get right now. We have the largest share of the largest living generation between 29 and 32 years old. Plus, every year for the past 6 years, I've been doing a millennial survey. We asked recently, this survey closed in January, did you save more money over the past 12 months compared to the prior 12 months? 70% of the millennials in our survey said yes. Why? Well, some of it was the stimulus checks. Some of it was the lifestyle change. And a lot of it had to do with what we've seen with student loan debt. So let's play this out. We have 2 people that are married or living together. Both of them were lucky enough to retain their job throughout the pandemic. Both of them have the average student loan amount, and they just found that money to be gravy. They were already paying it for student loans. They didn't have to pay it since the beginning of the pandemic. They've just been saving it. They've just been putting it away. In markets, in San Antonio, that gets people almost a 6% down payment alone. Houston, Dallas, we're talking 5% down payment. In the resale market, that's maybe not that impactful when a lot of buyers are looking for all cash or looking for the highest down payment, 20% plus. In the new home market, this is hugely important. You have now this buyer pool that maybe didn't have a down payment at all before the pandemic that now has some of the money to bring into the system. Some of the millennials also have the bank of mom and dad. Not all of them, but we know that as the boomers got more wealthy, some of them have contributed to millennials playing in the housing market. But then you look at Gen X and boomers. These are some of the groups that are more likely to have money invested in other assets. And the way I look at these and the strength behind these is we had equities and equity plus lifestyle changes. So when you look at lifestyle changes, boomers, we've seen more boomers retire since the beginning of the pandemic, and Gen Xers, more remote work, more flexibility, working from home, moving to different parts of a market or out of market that we'll talk about. So when you're looking at the stock market, only about 50% of people have money in the stock market, concentrated more so towards the boomer population. But we also know there's the wealth effect, and people just look to the stock market as guidance of what's happening in the economy. When you look at the S&P 500, up 80% compared to where it was over the past 5 years. Obviously, we've seen volatility recently. We're not in the business of forecasting stocks, but we're tracking this. Like I said, this could have been one of the positive factors that we'll look at how it plays out in the future. But stock market, generally, people are more wealthy than they were before the pandemic. And then you look at home equity. This is the change in average home equity compared to last year. I want you to look at Texas. The market average is 43,000. Of course, there are certain markets that are going to have a lot higher than that. I want you to keep in mind somewhere like California, the highest in the country, 119,000. There's a reason I'll have you look at that in a moment. When you look at equity, why does this matter? Well, if you're trying to move up within your same market, it's probably not that impactful. Everything else has gone expensive. If you're doing a cash out refinance, this is important. If you're moving down, this is important. If you'll move a little bit further away within the same market, this is important. And if you're going to move from one market to another, that's when understanding this map and looking at the equity gains becomes so important. And it's fun to talk to many of you in Texas, because when you look at U-Haul's data that came out earlier this year, Texas was number one. It was number two last year for the most one-way trucks. And this year it was number one. We know that there's a lot of data that points to increased migration in the Texas markets. So Dallas, 25% of the searches are coming from elsewhere. When you look at Austin, 31%, tied in Houston, 43% in San Antonio. Now, remember, I told you to keep in mind California, 119,000 in the average equity. When you look at Dallas, the number one place where people are coming from is LA. And when you look at this, we pulled up what's the median new home price in Dallas, 510,000. We looked at what the square footage was. We applied that square footage to LA and said, well, a like-for-like home for someone in LA is $1.3 million. So as people move in, this idea of sticker shock becomes way less of a conversation for people, where if home prices go up to 700,000, you're still getting a 2,500 square foot home for $700,000. That feels like an absolute steal for some people in certain parts of the market. Now, like I said, this conversation from the buyer point of view, very, very high level, but I want you to think about how these different factors that we talked about, the wealth, the relocation, are making the idea of trying to quantify the true depth of the demand and the true affordability more challenging than what we've seen in the past. And we'll talk about that as we go through our final section. Forecasts and final thoughts. I have 7 minutes left to get through a lot of slides, so buckle up. As I go into our forecasts, I want to start with single family housing starts. And we're calling for 5% growth this year in single family housing starts. Our range is 2 to 5%. Now you see here, I'm saying we're calling for additional growth, but with a little bit more caution. I'll kind of go through in this presentation why I'm saying the idea of a little bit more caution. But as we look at starts, there are a lot of things that play into our forecasts. And I found out fairly recently, we're actually on the high end of starts forecasts, which surprised me, because for us, we're thinking about a lot of different things that are happening on the ground in the market. We know that we have 73% of builders in Texas that are saying they're running into these government service problems that are stretching out the time from start to completion. 85% are running into a labor shortage, which mirrors what we're seeing on the national economy. 95% saying building material cost, building material availability, supply chain challenges, really just wreaking havoc on the process of getting homes built. So as we're going through our forecasting process, we know that there's a lot of lot activity, lots under development. We also know there's a lot of production capacity limits. So we're trying to weigh the different factors in today's market. This data is from Builders FirstSource. We at Zonda have a really good relationship with them. They're able to look at the different components that go into building a home. And they're able to say, okay, well, what is likely to happen? You see, I've underlined some of the timeframes. Some parts of the building components are likely to have freed up capacity constraint gradually throughout this year. There's new production sites that are going to open and be operational in 2024. Look at gypsum roofing on the top side, no additional production capacity coming on board in 2022. These are all factors that we need to be thinking about. And by the way, the reason we're calling for growth is last year, a lot of builders said they gapped out. Gapped out meaning they didn't have land. They were just sitting there waiting for their land to get developed. They weren't doing anything. So we know that some of those builders have a little bit more capacity to take on. Now, like I said, we also look at lots. And by the way, let me tie this back to the discussion. The additional home building can help free up that question. Remember, I said, if you're an existing homeowner and you sell, where else are you going to go? And builders haven't been able to adjust for that. These upcoming lots can become available to builders, can become available to consumers. To me, this is so important and holds the key to how the market can progress. So when you look at total upcoming lots, from 2019 to 2021, we were basically flat. Second quarter 21, we had 14% year-over-year growth. Third quarter 21, 14% year-over-year growth. Fourth quarter, 26% year-over-year growth. Let me put these numbers into something more actionable or something more understandable. We're talking about a lot of lots that are under development. They're in the roadwork phase, the excavation phase, the equipment on site phase. Put another way, there are 6% of lots that are under development that will become available to builders this quarter. That's the streets in, that's that 7% of the pie. Sorry, 6% of the pie. When you're looking at that, that means that a builder can start going vertical right away. 25% are in streets paved, likely to become available to builders in the second quarter. Once they go to a builder, they can start building on it. 70% in excavation. Let's really actually think about that. 70% of the lots nationally in excavation, Dallas basically exactly online with the national picture, which means those lots become available to builders end of this year. Those lots become homes available to consumers end of next year. So we see a lot more building to come, but of course there are constraints that may limit some of those lots from ultimately turning into home sales. And we'll talk about that a little bit later. Now, as we go into our home sales forecast, know that we at Zonda forecast new home sales publicly, existing home sales privately. I will not show our existing home forecast, but I believe Gay will show that when she comes on her presentation, what the NAR is seeing for overall existing home sales. But to us, sales really becomes an output of what's happening in the market. We know sales become dependent on supply. Now, by the way, we're calling for 10% growth in home sales. The reason this number is higher than our starts is because we know a lot of builders shifted their strategy. They did more spec building. And as they do more spec building, that becomes available to consumers today. So some of the specs of last year become home sales in today's market. That's why it's high. I would say we'll likely bump this forecast down. So sales dependent on supply, on sales caps, remember we talked about that earlier, and affordability. That's where I want to take the last couple minutes of today's presentation, is talking about rates. I started this presentation with the idea that February has been actually a great month for home sales. And I think a lot of people are saying, well, then interest rates don't matter because home sales are still going really great. And I'm here to say, don't ignore the impact of rising interest rates. We've been able to brush it off, but I do think we'll start to get to a point that if interest rates continue to rise, or if they flatten or go down a little bit, but home prices continue to rise, you run into this compound effect for affordability. Let me put this again in a more maybe easy to understand term. If someone was completely capped out, they could not have put another penny towards housing at a $342,000 home at a 3% interest rate. The equivalent monthly payment at a 4% interest rate from 342 is 297. A 1% change in interest rate translates into a 13.2% change in home price. Now, here's why I care. When you look at the home price to income ratio, I have been presenting on this. I have been ignoring this. We are higher than where we were during the mid-2000s housing boom. And the reason I've been ignoring this is we are not a price business. We are a payment business. People are looking at rent versus own. When you look at the payment to income ratio, it shows you a different chart, but that's 3.5% interest rates. This is how the chart would look if I filled in for 4%. We do know that 4% does really start to push that payment to income ratio up. And for a while, really for the past 2 years, I've been able to say, hey, home prices are going up, but low interest rates are offsetting that. The days of me being able to say that are behind us. We're now seeing as interest rates go up or as home prices go up, that does impact the consumer's bottom line. But think about this. I started earlier about how there were different categories that are trying to understand the true dynamics of the market harder. We're talking payment to income. Income adjusted for inflation for some consumers is flat to negative. Wealth for some consumers adjusted for inflation, actually positive. In particular, if you're looking at boomers. Remember those relocation shoppers, a $1.3 million home versus a $500,000 home. Relocation shoppers, not as sensitive to this. Lower income versus higher income. Higher income, not as sensitive, depending on how high income. First time buyer versus move up. You have a lot of factors that are coming into play that's really making it difficult to understand what is really the cap of affordability. Layla, I have 2 more slides and then I'll turn it off to Gay, which is just looking at what are we seeing on the ground with closed loans. So I think one of the ways you can track this is how is buyer quality holding up? Now, when you look at the back end debt to income ratio, you look at the average FICO score. The first thing I want to say to you is this data is through December. That's before interest rates went up. But what we were seeing in this data was a little bit of an increase in the debt to income ratio, a little bit of a decrease in the average FICO score. Not alarming, just getting us back to some of the pre-pandemic trends, not that every single buyer was absolutely pristine like we saw during the height of this housing market since the pandemic. Quality is still strong, but what I'd say from our builder survey, we have been doing this, like I said, every month since the beginning of the pandemic. I have gone through every single comment every single month. And this is the first time I've seen more comments like this. Starting to see challenges with interest rates, some mortgage issues. We are starting to see buyers that can't qualify at higher prices. That to me is something really worth watching. So my final thought, I had to go through this fast. I talked about the land and lot under development. We do believe, and we know from the rental side as well, there is a lot of money and time spent in getting these lots developed to bring more homes to the market. We know that the supply chain, well, I guess we assume the supply chain will start to free up over the next 12 to 18 months. When these lots become available, I'm watching for how are consumers ready to absorb those higher prices. We know right now we have this geopolitical risk. We know there are winners and losers in today's market. And I think the most important thing is watching how mortgage rates progress and how the economy progresses in the light of some policy changes that are likely to happen soon. So with that, I'm going to stop screen share and I am going to pass this off to Gay. Let me give her a proper introduction really fast. Gay is my friend and the senior economist at the National Association of Realtors. You heard Layla give her the long introduction. The only thing I will add is Gay and I became friends, I guess virtual friends on LinkedIn. She posts a lot about the trends that the NAR is seeing on the ground. And I always learn a lot from the different things that I see. So Gay, I'm excited for your presentation and I'll hand it off to you.
Thank you so much for that generous introduction, Ali. Yes, Ali became my friend on LinkedIn. And in fact, I invited her to be a speaker in one of our seminars through LinkedIn. So thank you so much. And thank you to the Dallas Fed and the Texas A&M Center for inviting me here today. Happy to be here today. I have great connection with Dallas, both from a personal position, and Dr. Tracy knows this, but I'm going to announce it anyway. My daughter worked with him and she lived in Dallas for a while. So I was in Dallas, I think, for 3 times visiting her. So love Dallas and hello to our realtors out there. If you're one of the 900 listening to this video, I'm sure you all know that our current NAR president, Leslie Buda-Smith, is from Dallas. So with that, let me share my presentation today. So I guess you all see that. I am not able to move this to the next one. Hello? Hello? Sorry, it's frozen. Leila, let me just stop sharing again and reshare. It seems to be frozen. Can't move this. Hello?
Okay, we'll get your slides on. Just give us a minute. We'll share them on our end.
I was able to move them forward a while ago.
We're working on getting your slides up. Just give us a minute and we'll share them shortly.
Okay, thank you. Oh, Okay, so that means that in my head, I got to remember the next slide, kind of recall it. Okay, I'll just say next as I move on to the next slide.
Okay.
So you will control the slide?
Yes.
Okay.
If you can stop sharing your screen, I will go ahead and share mine.
Should I start presenting?
Hold on 1 second. I'm pulling up yours on my end, so I will have it up.
You can start, Gate.
Yeah, okay,
our tech is
okay.
sharing.
Okay, so Ali had spoken about the housing market outlook, and my task today is present to you about the apartment market outlook. Now, as you know, the demand for owner-occupied homes is a substitute for the demand for rental homes. And so with the rising mortgage rates environment, rising mortgage rates, although they did fall a bit today, I just checked, at a time when home prices are still rising, presents that affordability challenge for homeowners. But I think, as I will show in the next slide, really we're talking of two factors here, right? So on the one hand, there's the affordability effect. You got higher mortgage rates at a time when prices are rising, 16% year over year in January, at least for existing home sales. The last time that we estimated it, means that a homeowner buying a typical home pays $330 more a month compared to a year ago. Now, wages are not rising by as much. Average wage growth is about 4 to 5%. So just about a third of your 15% price growth, right? So that is already causing an impact on affordability. And so with mortgage rates even higher, as I said, you got $330 a month there. But on the other hand, there's also the expectations effect. We know that interest rates are not going to be at this low rate forever. At least there was more certainty before the geopolitical tension in Europe, right? We knew that inflation was up at 7.5%, the highest since 1982. And the Fed had already signaled that it will pull back its asset purchases and start increasing interest rates. And everyone was expecting rising rates. But even with that, inflation will probably just hit about 5.5%. We think our forecast is about 5.5% end of the year. And then by next year, end of the year, something like 3%. So the Fed will continue to increase interest rates. And if you're a buyer who has a more income than that marginal buyer, well, you'll think, I should lock in at this low mortgage rate now, right? We know that interest rates are going to increase and prices are also going to keep rising because you've got about 6.8 million of backlog in supply. And I'm very happy to hear that Alice said lots are going to increase by 25%. That's the best news, Ali. And that's the best thing that I got from that amazing presentation you had. But I think that was very important to emphasize that supply of lots are going to increase, which will ease that supply constraint. But, really right now we're facing the lowest inventory in years, 860,000 homes. Unsold homes at the end of January, which means that demand is outpacing supply because every month that level of unsold inventory at the end of the month keeps going down. And so again, with this potential rise in interest rates and the fact that home prices are not going to fall, but they will just increase at a slower pace, means that there are buyers out there who might decide to lock in. So I think in the next slide, I will show that the rising mortgage rates is also going to have an impact on the mix of buyers. So right now, we're already seeing that first-time buyer share declined to 27% in January, whereas cash buyer share rose from about 20% in 2020 to 27% in the latest survey we had. By the way, this is data from a monthly Realtors Confidence Index survey that we conduct. Essentially, we ask our random sample of about 50,000 realtors. About 5,000 will reply to that survey, and of that 5,000, about 1,000 will say they had a sale. So of those that had a sale, we asked them what type of buyer was that buyer? Was it a first-time buyer, non-first-time buyer? Did they pay cash or not? So that is the source for that information, just to be clear. But anyway, you can see there that as the share of first-time home buyer went down, share of cash sales and investor or vacation home buyers rose. Now, what does that mean? In a rising mortgage rates environment, even if you'll see a decline in first-time buyer share, I think you will see investors stepping in. And for our realtors, because this is a survey of realtors, our realtors mostly deal in the smaller end of the market. They're not dealing with these institutional investors, but they're dealing with the mom and pop. So they'll be stepping up, right? And why are they going to be stepping up? Because, well, rents are also rising right now. Vacancy rates, rental vacancy rates, both from what the US Census Bureau is reporting and from proprietary data sources like CoStar are reporting historic low rental vacancy rates. And so as an investor, you see rents rising by about 11%. Why not, right? Why not jump there and invest? Now, even prices are rising, but if you're a mom and pop, well, maybe you could use that home equity that you have built over the last 30 years and tap into that. So a home buyer buying a typical home just over the last 10 years, when prices grew at an annual rate of about 8%, has built up about $220,000 in home equity. So that's a lot of capital to tap into. So, but anyway, the point of this slide is even if you'll see a pullback in first-time buyer share because of rising mortgage rates, you'll have this other group of buyers that are going to step in. So that I think in the next slide, I will show that, yes, so even with high, that uptick in mortgage rates, which could hit about probably 4 to 4.5%, maybe 4.5% this year might seem too high now, just because maybe your bond holders or investors will try to shift into bonds. Things have become a bit more volatile on that end. But anyway, as I said, this interplay of impact of rising mortgage rates on affordability on the one hand, on rate lock expectations, on the shift of buyers, taking all that into consideration, we at NAR think that we're not going to see a big decline in home sales, even with rising mortgage rates. First of all, those mortgage rates of 4.5% are still historically low. And prior to the pandemic, mortgage rates were about at 4.5%. So you will just get back to that pre-pandemic level. And that 2.8% decline is about in line with, the decline that we saw when you had this US-China trade war, and then also US-China trade war, and what else? Yeah, essentially that was the big thing, right, after the collapse. But we're not going to see this, we're not going to see home sales falling by about 20%. That occurred during the Great Recession. So modest decline in home sales is what we're seeing. And then we're also seeing, I think, a modest acceleration in home prices, as I'll show in the next slide, if I recall correctly, correct? So we did see prices go up, as I said, by about 16%. But middle of last year, existing home prices were even up by about 25%. Right now, they're trending. Right now, as of January, year over year, existing home sales are still up by about 15%. So our forecast right now, and this is our chief economist forecast, Lawrence Yun, he's looking at prices going by about 5% modestly. I think this is more on the conservative side with prices, cost of production, the construction price index still going up by about 15%. I think there is still that cost push pressure, and inventory still remains tight. So maybe we'll see a higher price appreciation here. But again, the message here is prices will continue to rise. They're not going to fall, and prices will continue to rise. And what does that mean in terms of inflation? Well, that means that rents, with prices rising like this, right? And if you're an investor, of course, you want to make money on that price that you will buy, so that you'll purchase the house for. So then rents, which is really the payment that is factored in your consumer price index and which is being factored into inflation, will continue also to increase and be supported by that price growth. So on the right, you'll see here, as I said, listings. We have never seen the unsold listings as of the end of the month go this low, about 860,000 in January. In 2012, listings were 1.8 million. This is the right side. And in terms of the supply of inventory relative to demand, in 2012, that inventory of 1.8 million was supporting 6 months of monthly demand. Now that 800,000 in inventory is just supporting less than 2 months of supply. So still very tight supply conditions. Our forecast calls, I think, for about 50 to 70,000 additional housing starts. Housing starts will be trending at about, I think, 1.65 million from about 1.59 million last year. So not a whole lot of increase yet in housing starts. And because you also still have this labor shortage, we got construction workers that are still, I think, 200,000 below the level that they were during the Great Recession. So you still have those, as Lila had mentioned, operational constraints. So we're not going to see supply significantly ramping up, and that will provide your anchor for these home prices. So there, with that backdrop, in the next slide, let me now go to briefly the factors, right, that will drive the demand for both homes and rental apartments in the coming years in Texas, at least 2022, 2023. And so this slide just shows really the net domestic migration is going into the Sunbelt market. So Florida was number one, 263,000 people moved there. So that's about what, 26,000 owner homes, right? If you have like 2.6 2.6 persons per household. Texas, about 200,000, and in the South. So this domestic migration is going to fuel demand for both homes and rental apartments in the Texas area. And why are people moving there? A lot of factors. Could be because there are no taxes there. Could be the warm weather, but I'm not going to go into that. But essentially, there's a lot of people going into Texas and into the South markets, and that will be driving up demand in the future for rents and owner-occupied homes. I think in the next slide, the other factor, of course, that will drive housing is employment, right? And here I'm tracking what was the net job gain or net job gains in terms of non-farm payroll relative to February 2020 or the pre-pandemic. That is now the new benchmark. Who's the number one job creator? Dallas, 113,000. Austin is there, Phoenix, Austin, Salt Lake, and then I think San Antonio. There it is. So San Antonio. So really you got Dallas, Austin, San Antonio. But we did see here that Houston has not yet recovered. And I thought I had it here. There it is. Houston has not recovered 44,000 jobs. But well, who knows, with the political tensions, we might expect to see oil production ramping up in the United States, and oil producing states, certainly Texas, Colorado, North Dakota will benefit, unfortunately, from these tensions that are happening right now. So the next major factor affecting demand is work from home, right? So why did we see an increase in demand? People are coming back to work. So there's a lot of estimates out there. Well, what fraction of people are going to work? Well, right now, the U.S. Census, the U.S. Bureau of Labor Statistics data is showing that just 11% of people are working from home. There are estimates out there that say, well, 20% will be working from home. But if, of course, in the office using jobs, it's about 20%. But that has gone down from about 54% during the lockdown, and from about 55% for the office using workers to just 20%. And in terms of numbers, that's 48 million workers to just 17 million. So right now, the model, I think, is really hybrid model. That is what is evolving. And if it's a hybrid model, the impact is that if I work in Texas, if I'm working in California, right, or in Texas, some state, and if I still have to report to work, well, it doesn't make sense for me to move to another state, right? But what will happen is you will probably move further away. Like if I'm in let's just say I'm in Austin, right, which is relatively more expensive. Well, now that I can work from home, maybe I want to move to San Antonio, less expensive, a few more minutes to travel, but hey, I don't have to travel 5 times a week. And so that is the effect, that there will be this increase or shift in demand, from your primary counties in a metro area to the outlying areas. And I think Dr. Tracy had already mentioned that tomorrow there will be an excellent presentation on this. So yes, looking forward to that presentation, and I hope you all still stick in tomorrow to listen to that presentation of where migration is heading and the impact on the housing market. Next slide. So then with these factors, one more slide to show that, you got that increase in net household formation in 2021. You saw that net household formation decline in 2020 and went up again 2021. And I think I broke this down. I think this was about, and I'm not showing it here, but if you look at the breakdown of this thing, the increase in net household formation was of the younger folks. And also those who were high school graduates or those with just an associate's degree, because as the economy opened, these jobs that closed, right, related to the food business, your hotel business, jobs that tend to be taken by the low-income workers left, but then they came back again. And Dr. Tracy had an excellent paper about that, right? About how that affected the wage rate. We all saw wage rates going up, but we knew that, hey, this can be true. That was just because of, an arithmetical, a mathematical effect, because you're averaging something, but you're averaging the wages of people who were still working. And so, of course, wage rates probably went up because now you got it from a low wage. You got it from when you factor in those people who did return, right? So I think, in fact, that wages should go down on average than if you had not factored them in. So that's it. And then Lila, so just keep going. I'm afraid I might run out of time. So in the next slide, let me now go to the multifamily. So with those factors in mind, you saw multifamily demand go up about 1 million units absorbed since 2020. But lately, we have seen, at least in this first and second quarter of 2022, apartment demand already easing. So typically your absorption is running at about 80,000. We saw that uptick in 2021 because of the net household formation, maybe people returning to work, but that is now normalizing again to about 70,000. So in the next slide, we show that where did they go? The largest absorption, Dallas, Houston, Austin is one of them too. And then San Antonio again here. They're leading these metro areas have the largest net apartment absorption since February 2022. And here I'm using CoStar data. But I just want to emphasize here also that your gateway cities aren't dead, right? So New York, you got people coming back, Los Angeles, Atlanta, Washington, DC. So they're not becoming ghost towns. Renters are coming back there. And so in the next slide, let me show that if you see what's happening though, so I've spoken about though this tapering of demand. So you saw, for example, in New York, 2.4, so this is actual figures, not in thousand, 2,400 net absorption in apartment units, ramped up in, and unfortunately, I don't see the axis here. I think this ramped up somewhere in 2021, second quarter, and then, but that has tapered now. So it's still positive. That's a good thing. On net, you still have apartments being absorbed in New York, Boston, Chicago, DC, LA, San Francisco, these gateway cities. And on the right, you'll see the net apartment absorption for Dallas, Houston, Texas, all positive as well. 2,700 apartments absorbed in Dallas, and areas like Atlanta, Miami, Arizona. So I just put here the big states. So bottom line, you still have net positive absorption for apartments, but it's tapered compared to your 2021 pre-pandemic surge. So really it fell and then it just surged, but now it's normalizing, which is good for rents, right? We're not going to see our rent growth kick up too much. We always want a balance of demand and supply. So in the next slide, I will show here that, it was just interesting to see that where is the demand coming for your net apartments. It was actually in your class Bs and Cs. And class B and C, there might be a loose definition here. Again, this is from CoStar data, but I guess class Bs and Cs tend, to be more affordable. They tend to be found in your suburban areas, whereas there was a decline in your class A. So I think this is a positive trend in terms of affordability and this mix of more affordable class B and class C is going to bring down that rent growth. And I hope, Ali, the builders are building more class Bs and more class Cs. Okay, next slide. A vacancy rate. Again, just another indicator that you saw vacancy rates fall because of that steep demand, but they're rising a bit now, but still very low, a rental vacancy rate of 5.1%, below the level pre-pandemic, which is about 7%. Interestingly, though, the highest rent growth here is for class A. Right, but then even if they have the highest, the highest vacancy rate is for class A relative to class C. Class A, 7.7% vacancy rate. Class C, just 4%. But interestingly, and I don't know why this is happening, but your rents are rising. Your asking rents are rising much faster in your class A, where there's higher vacancy compared to your class C. And maybe this could be due to cost push factors or the amenities, right? Class A's have more amenities, there's increased production costs, and so that is being passed on to asking rents. So I think that is what might be causing this higher asking rent growth for class A than for class B's and C's, even if there's a higher vacancy rate in your class A. Next slide. Again, just another indicator of where rent growth is right now in Dallas. Rents have picked up, asking rents have picked up 15% year over year as of the second quarter. Houston, 10%. Austin, Austin is the hottest in terms of rent growth, 19% year over year rent growth, and also Phoenix. More modest rent growths in your gateway markets like New York, just 5%. But DC, among the gateway metro areas, you've got Boston that is experiencing the highest rent growth. And I think among the gateway cities, it's really Boston that's doing the best. Even if you look at the office market, Boston is experiencing a net increase in occupancy compared to the decline in occupancy, in office occupancy for New York, Chicago, LA, San Francisco, and Boston is the office demand in Boston is being lifted by your demand for biosciences and tech. And the next slide, we'll see here that I like this slide because this slide shows that demand is still outpacing supply. So net absorption, even if we said it's normalized, right? Even if we were saying that the apartment demand has normalized, that demand is still higher than supply. You got 570,000. Now this is on a 12-month basis. You got 570,000 in net absorption versus 460,000 in deliveries. So you still have that gap between demand and supply, which is going to hold up and push up rents. So that's why we won't see rents really falling, even if you'll see a slower demand. Next slide will show that construction is still there, but it has tapered a bit. And here again, there's this interesting development that there's more construction for your Class Bs and Class Cs. So if there's more construction in your Class B and Class C, and these are your more affordable markets, so I think we'll see a rent growth here. We'll see because of the mix, right? Then on average, you'll see rents falling. In terms of rent growth, though, I can't quite say what's going to happen to rent growth because you also have those cost push factors. But anyway, the market demand is shifting towards more Class Bs and Class Cs. And again, as I mentioned, I think these are apartments that tend to be in your suburban areas. Next slide. Top areas for construction. Well, Dallas is there again, but builders are still bullish on the gateway cities. So that means they're not, they don't think that these cities are going to die, So New York, Washington, D.C., Dallas is there, Austin, where else? I think, most apartment units, it's really positive. There are very, very few metro areas where construction is negative. There's a lot of construction going on for apartments, and because rent growth rents have been rising, right? And I guess builders are saying, and their argument is, well, house prices are rising because of affordability. People want to rent, and so they're moving into that market. But as a percent of the existing stock, the intense construction is really happening, at least among the Texas metro areas. It's in Austin. This 24,000 units under construction currently accounts for about 10% of the existing housing stock. And just overall, where is the demand shifting? You can see here that most of these are in your Sun Belt areas: South Carolina, Florida, Tennessee, North Carolina. And then in the West region, it's Utah and Idaho and Washington. So I think I'm almost about ready to end. Next slide. There it is. What is the NAR outlook? I think vacancy rates will continue to remain low for multifamily because of the impact of rising mortgage rates on the demand for rentals. So on balance, we'll see a higher demand for rentals for multifamily. So we expect to see that vacancy rate still falling. We could be wrong, plus or minus, right? But I don't think this vacancy rate is going to go up anywhere to 7%. It'll be hover around 5%. And asking rents right now, they're about, as I said, 11 to 12%. I think because of the cost of construction, because of the shift in demand towards rents. So we'll still see rent growth at about 10%. mean, I didn't present today about the office, industrial, and retail, but we do look into that. And among all of these sectors, really the commercial sector has been driven by your growth in multifamily and industrial, but even retail was a surprise because there wasn't much building going on prior to the pandemic. Rents, the vacancy rate in retail has been really low, 4.6%. Rents are growing 7.4%. And if you look at retail, the retail stores, the types of retail stores, retail property types that are benefiting as your neighborhood centers, not the malls, not the big malls, but your neighborhood centers. And again, that is indicative of the shift in migration to the suburban areas. And of course, you need to buy food, you need to go get a haircut. And for people who are retiring in, say, Florida, Texas, well, you have these little, offices for doctors, for financial planning, so you've got also a demand for offices there in the suburban area, which I wasn't able to show today. But the office market is lagging. But if you look at the data, office markets in your secondary markets are booming again, like Boise, Idaho, Dallas, I think Austin. It's really New York that is suffering. So with that, thank you so much. And I'll take questions.
Thank you, Gay and Ali, both of you, for your excellent presentations. We'll turn into the Q&A. We've had quite a few questions come into the in the Q&A feed. Just as a reminder to everybody, we've been getting questions on the presentations. All the presentations as well as the video recordings for today's event will be available via the conference webpage after the end of the event. So the first question out to both of you, and we'll start off with you, Ali, first. A home and rent price appreciation has been off the charts in the past year. Sunbelt markets such as Austin, Phoenix, and DFW have by far seen the largest increases in home prices and rents. Based on fundamentals, what Texas or US metros are best poised for growth in 2022?
So I want to keep the answer to Texas. I was just in San Antonio recently, and I feel like San Antonio is probably, I don't know if it's the obvious answer, but to me, it's the obvious answer. I spent time in San Antonio probably like 3 weeks ago now, and there were a lot of things that I saw going for the market and a lot of transformations happening. So I think the work from home was really important. When you look at the longer term history of San Antonio, at least what I was told is there was always just a little bit of a lack of job diversification and having a lot of different roles that were there that supported different incomes. And it seems like with the work from home, that's supporting some of those changes. When you look at where people are moving to San Antonio from, it's usually other markets in Texas, where on a national basis, Texas still looks affordable. But when you look at different markets compared to where they've been, you look at Austin, obviously that's the example. People are leaving Austin and going to San Antonio for that opportunity. I felt like the culture was there, the food was there. I tend to eat close to vegan. There were vegan, like there was just so much stuff there that I felt like this is one of the underappreciated markets, and home prices can still be under 300,000. Not often, but that's really rare when I do presentations across the country. So I would say San Antonio.
Kay, would you like to add anything?
Yes, I second the motion. What Alice said, I think San Antonio is the next metro area in Dallas. And really, we did a study of this. Earlier this year, we came up what we call our hidden gems market. And what we did was we looked at fundamentals like job growth, wage growth, migration. And then we said, well, if we look at the 400 or so metros, and look at kind of like the distribution, which of these metros are in the top part of the distribution when it comes to these fundamentals, and which are below. And then we also looked at price, and we saw that in terms of this underlying fundamentals, wage growth are not growing as fast. There's a lot of employment opportunity there, people migrating. So San Antonio was on the 50% of the distribution, upper 50%, but in terms of price, they were still on the low 50% of the distribution. So we said, it's still an undervalued market. It's a hidden gem market. So yeah, and if you just go to San Antonio, just the food, as Ali was saying, that Riverwalk, beautiful, and of course it's relatively close to Austin. which has gotten quite expensive. But having said that, I think Houston, possibly with the effect of these geopolitical tensions, if oil production ramps up again in Houston, so we will see again job growth in Houston and Houston market picking up.
So next question is on lots. Ali, what is your outlook for upcoming lots in Texas markets? Will the timing of when this results in new homes sold be the same as for the nation, 2023?
Yep. So when you look at the lot distribution, I know I had to go through that quick, but one of the things, if you remember, when you look at the distribution by the national market versus the distribution by local markets, the Dallas distribution was basically completely on par with the national number. So remember, it was 70% of the lots that were likely to come to market to builders at the end of this year. And then those homes become available to consumers at the end of next year. But keep in mind that there still was that 70%, that leaves 30% of those lots that are going to become developable and you can start going vertical on right away. So I think we'll see it trickle in throughout the year. But when you look at the distribution, it looks like more of it is packed towards the next, I'd say, 8 to 18 months.
Okay, a quick follow-up question on lots. There's a question about lot sizes. What are the shares of lots by lot size that are being developed?
So we have this in our database. I did not pull it before this event, but the individual that sent that is feel free to send me an email to get it. It will depend on market. The one thing I'll add is I was in Houston Monday, Tuesday this week, and I'm not going to talk in lot sizes. I know that's how Texas does, but I'm going to talk in terms of the house width. There was discussions of in Houston now having 20 wide single family detached homes. And so there is the acknowledgement that, again, even though Texas is affordable on a national basis relative to itself, there have been huge shifts. I think the easiest thing I can say is we used to have more of the distribution to the right, 60, 70, 80 foot. Now I'm saying it's going over to the left.
Okay. Another question, and I know we're at time, so we'll extend it by a minute or two because we have a lot of good questions coming in. Given high home prices and rising mortgage rates, is this a good time to rent or buy?
I could start off with that. Well, let me just say that, renting or buying depends on many factors, right? Other than just, price. Depends, I guess, on your lifestyle. If you're a millennial and you think, well, I really am thinking of buying a home in the next year or two, I think if you're that kind of a buyer, you can buy now, right? Because mortgage rates are going to go up higher, prices are not going to fall. So yeah, buy now. Now, if you're a second home buyer also, I think rents are going to go up. Again, you just make a decision. Rents are still up, prices are still going up. But and if you can, as I said, invest in those Class Bs or Cs or in the suburbs, there's great opportunity there. I think, buying to rent would be a good investment strategy there. It's hard to say in general if it's a good time to rent or to buy, but I would say actually in general, because about 80% of people still aspire to be homeowners, right? In general, if you're an aspiring homeowner, and most people are, I think it's a good time to buy now because rates are going to go up, prices are going to go up, and you don't want to be hit by a double whammy.
Okay, and we'll wrap up the round with this last question. I think we'll be amiss if we don't talk about the build to rent phenomena that has been gaining so much popularity with many home builders constructing entire communities of rental homes. And so what's driving the demand for BTR homes? Who's the target demographic for these rental homes? And do these communities create competition for the single family or the multifamily market?
So I can start with that one. So at Zonda, we have an advisory business, and our advisory business is traditionally looking at master plans or looking at segmentation, feasibility studies. The biggest part of our business by now, or I guess the largest growing part of our business, is a single family built for rent. And when you talk about this, you have to break it up. So you have your single family platted lots where they could be sold individually, and you have your horizontal apartments, which are like pulled apart, or I guess they're like pulled apart apartments. So when you're looking at the horizontal development, that's on one platted lot. They cannot be sold individually. That's going to be more for lower income folks, 2 household folks. Millennials will go there. They're just looking for a little bit more space. That would be more competition to the multifamily side. When you look at the single family, the single platted lots, those ones are going to be larger. They're going to have a higher rent. They're going to be catered more towards families that maybe don't have a down payment they can't afford. What I'm hearing from people in the industry is that it's almost a segmentation. It's becoming the single family product. If you're trying to get a single family home, this is your way. It's very difficult to build for sale homes with this. So you're doing the for rent. The one thing I would say though, is it's almost getting a bit too hot. We've seen returns really get compressed. We're seeing it go into markets that it doesn't really work. We do think there could be a day of reckoning where there's a lot of, I guess the phrase is dumb money that's coming into the space. People that maybe shouldn't be in it. They don't have the expertise. They don't have the history. They just think it's an easy way to make money. That's what I think we should watch is how does it flesh out? Because there's a point where we could actually see some challenges on that.
So we're right about, I think we went a little bit over time. So thank you everyone for tuning in this morning. Sorry if we were unable to get to your question. Thank you, Ali and Gay, for your insightful remarks. And thank you to the audience for your questions that made the discussion engaging and robust. Our upcoming panel will focus on commercial real estate with an emphasis on the future of the workplace. The panel will begin in about 5 to 7 minutes. We had a 10:20 Central Time start for it, but we'll push it back by a minute or two. So see you all shortly. Thank you again for joining us this morning.
Thank you for having me. Thanks.
My name is Ariel, and I just started my first job as a project manager. When I was
Stay with me if you wanna. Stay with me if you wanna. Stay with me if you wanna. Stay with me if you wanna.
Hello, I think you're all here. Welcome to on Risk. We have a lot going on in the world of real estate, and here to help us are two panelists, both of which you guys may be familiar with or maybe not. If this is something new, feel free to reach out to them afterwards. We have Sam Tenenbaum, who's the Director of Analytics and a market economist specializing in market research and economics. CoStar, the world's largest commercial real estate data and analytics company. He's based in Austin and leads all of the research for Central Texas, where he focuses on predictive analytics, risk assessment, and multi-sector market research for institutional, family office, and private investor clients. He's been quoted in such publications as the Washington Post, the Austin Universal Statesman, and he's often asked to speak at events such as CCIM, the Department Association, and he regularly keeps up with all of CoStar's filter investor and lender clients and keeps them all up to date on the latest trends here in the Renaissance space. He previously directed Latin America market research and risk assessment for GIMB Advisors. He's a member of the Downtown Austin Alliance Research Group and the Urban Land Institute's Multifamily Council. He graduated from McGill University in Montreal with a degree in international development. So welcome to Sam. With us today, we also have Peter Miskovic. He's the Managing Director of JLL Strategy and Innovation Practice. He's based in New York and is co-author of The Workplace You Need Now, which is an Amazon #1 bestseller. It was published by Wiley Publishing in November 2021, so it's sort of hot off the presses, only a few months old. He's considered a workplace luminary who's focused on the future of work, leading executive leadership teams in the strategic execution of enterprise transformation engagements. And let's just say he's worked with a number of multiple Fortune 100 corporate headquarters on what they need in terms of workplace. He's a former partner with PricewaterhouseCoopers and developed CRE workplace organization performance and improvement programs and many other ways of which he can work in a hybrid way, all of which he will explain. He holds degrees from MIT as well as the University of Arizona. So welcome to Peter. We're so glad to have you here. Cam, how about you lead us off? Tell us a little bit about where we are right now in commercial.
Sure thing. So for those of you that couldn't hear Candace, because I think your audio was a little wonky, I'm Sam Tenenbaum. I'm the director of analytics for CoStar. We're a real estate data and information company. We own things like LoopNet and Apartments.com and a bunch of other things. But my job is to kind of talk about what's going on here in Texas. And so with that, I'll start sharing my screen here with this presentation here. Let's do that. And hopefully we're good to go. All right, so we're going to cover a lot of ground today, but we're going to start with what's going on in today's industrial market, which is, I think, pretty safe to say of the three non-apartment asset classes, maybe the most exciting asset class out there. For a lot of reasons, realistically, we have all of the drivers are all headed in the right direction. And so when we think about the industrial market and the things that move the industrial market forward, there are three real drivers here across Texas. The first one that I want to talk about today is manufacturing. So here we're looking at the demand for manufactured goods or manufacturers' new orders, as you can see there. The demand for durable goods has been incredible. I know there's a lot of talk about inflation and all of that fun stuff, which obviously impacts commercial real estate. But I think the big piece to kind of understand is that the demand for goods that are made is incredibly high. And those goods obviously, are not just stored in warehouses. I mean, that's clearly part of it. There are also a lot of those goods are actually made here in Texas. So we've got the Tesla factory in Austin. We've got semiconductor manufacturing plants going up across the state. We've got Navistar building 1 million square feet down in San Antonio to build trucks. There's all sorts of manufacturing operations happening across the state that are really continuing to drive the industrial market here. The other driver, of course, is e-commerce, right? We all know, we all know that, at least I have ordered a lot more stuff from Amazon over the last year and a half as folks, have kind of been, or I guess 2 years at this point, as folks have sort of been stuck at home. We've seen this shift in purchasing goods online and getting those delivery times shorter, which means we're seeing huge demand from e-commerce suppliers across the state, especially in Dallas, but we're also seeing a lot of growth in Houston and Austin and San Antonio as well. The third driver, I didn't want to create a slide because I didn't want to step on the presentation before us' toes, but you all know that we're building a lot of new housing here in Texas as well. And so the fact that we're building a lot of those housing means that because the local economies are doing incredibly well as well, we sort of have this trifecta of trends behind the broader industrial market, which are really driving a lot of demand for industrial. Here we're looking at new leasing activity. In this case, we're comparing 2021 to 2020, and then the pre-pandemic few-year average to kind of give you a sense of the shift in the market. We'll use this chart for every other asset class as well, so get used to seeing these colors. But the concept here is each one of these bars represents a different time frame. You can see it broken out by each individual metro as well. Across the board, we've seen a real uptick in demand for industrial space over the last 2 years. You look at 2020 in every market with the exception of Houston, which was about average of where it was prior to the pandemic. We saw an uptick. You look at DFW, we went from 48.5 million before the pandemic to close to 60 million in 2020 and now 70 million in 2021. You look at Austin, which is a much smaller distribution market and much smaller, Austin and San Antonio, I should say, are much smaller markets than Dallas and Houston are, as you can see by the scale on the chart. But we've seen an incredible amount of new demand in those markets as well, generated by, like I said, the local home building trends, but also, in Austin and San Antonio, Amazon alone is building about 5 million square feet apiece in each one of those metros. So 10 million square feet in a small industrial market is a huge market mover. And then you look at, a place like Houston, where we've seen incredible demand, not only from e-commerce, but just across the board from third-party logistics folks, from folks at the port, just expanding room near the port. It's really been sort of an economic powerhouse Texas has when it comes to the industrial market, led, of course, by DFW with its incredible 70 million square feet. Now, of course, this isn't a secret. We've seen a lot of construction come to the market over the past few years. You look at DFW almost doubling up the next biggest market in terms of construction activity. It's really impressive to see the amount of new supply that Dallas continues to add and then continues to absorb as well. There are a lot of folks out there that think maybe we're building too much industrial space. You see 60 million square feet. That's more than any other metro. That's basically all of what's being built in Atlanta and Chicago combined, just for some perspective. It is an incredible amount of new construction. But if we flip back one chart and we look at the amount of leasing that Dallas has seen over the last year, well, maybe it isn't. Maybe we aren't building enough to keep up with the pace of leasing activity and the pace of demand in these markets, because industrial is going through such a huge transformation at the moment, not just from an institute, like from an investor perspective and things like that. From a use perspective and an efficiency perspective, we're seeing new heights reached on clear heights, or the height of the buildings themselves, how many racks you can fit in. We're seeing robotic infrastructure being put into these buildings as well. So the amount of efficiency you can gain from all of these sorts of efficiencies means that a lot of the older stock in industrial really isn't at all competitive with what's new. And so, you can make an argument that there's some structural obsolescence as part of the industrial market, especially in a place like DFW, but in some of the in-town areas. It's one of the reasons we're seeing a lot of demand, in particular on the investment side, not just for the big giant boxes that house Amazon and every other, large credit tenant. We're also seeing demand for those in-town locations as well, the sort of last mile distribution, as it were, which is really helping to drive a lot of that demand, because those industrial buildings are, generally speaking, closer to population centers. But because they're closer to population centers, and we as a population in Texas continue to grow at an outsized rate, we're starting to see those industrial buildings maybe have a higher and better use for housing or retail, or something that more directly serves, or apartments, I should say, as well, not just single family housing, but apartments as well. And so, as a result of those kinds of trends, we're seeing some of that structural obsolescence, but some of this transaction activity as well is being purchased to be converted to other uses as well, which again only helps the fundamentals of industrial space long term. But you can see, investors clearly love the thought process here. And if we just look at some of these macro themes here, like I said, the drivers for the industrial market around the country are incredibly positive. We've got international trade that we didn't even talk about. We've got goods being manufactured in Mexico. We've got the port of Laredo bringing in the highest value of goods of any inland port in the country. We've got manufacturing, we've got e-commerce, we've got the trends of onshoring as we run into supply chain issues. I think we're going to see a lot of folks bring goods manufacturing and goods production back to the US rather than outsourcing it to the broader world. And not to mention, on top of all of that, we've got incredible local housing dynamics, which continue to generate strong demand for industrial across the country. We've seen strong net absorption and leasing activity, some of the best years ever. In fact, the best years we've ever seen on the industrial front. We have seen development come back, which has brought record level of new supply. But the reality has been that the demand has been so strong for industrial space that it's really hard to kind of beat back against the waves of the supply here. Down below, you can see a couple tables with vacancy and rent growth projections for the 4 major Texas markets compared to the national level there. You see that on the vacancy front, we're typically a bit higher than the broader nation. Again, we build a fair amount of industrial space here, and we see a lot more obsolescence than in other markets. But the reality has been we've seen much stronger rent growth over the last year, or not much stronger. Sorry, we're projecting to see stronger rent growth in 2022 rather than the broader nation, as all of these trends kind of create more demand for industrial spaces as we look into the future here. Moving on to the retail market, I think these two asset classes kind of go hand in hand. You'll see a similar chart that we showed earlier here, but I want to start by talking about retail bankruptcies and store closures. We've seen, as I mentioned, really strong population growth, really strong economic growth here in Texas. But when companies like Pier 1 say we're closing all of our stores, regardless of how productive those stores may be or what have you, it does weigh on our local retail market. And obviously those store closures get all of the national headlines. And so it colors this perception that the retail market is really struggling. And it's not to say that every retailer is doing great all over the place, but when we start to look at some of the Texas fundamentals, which we'll do in a second here, you'll see that the retail market is really not dead at all. And the fact that we've seen far fewer retail store closures in 2021 than we did in 2020, obviously, if you made it through 2020, you were probably going to make it through 2021 as well. We've seen, incredible performance actually from in-store retail sales. So I know we showed this chart earlier where we looked at the red line, which was the share of e-commerce relative to overall retail sales. But what I want to point out here are the blue bars, which are retail sales and food service, which is, excluding e-commerce as part of it. We've seen a huge increase in those blue bars in 2021, which means we're seeing a lot more in-store shopping, which is generating really strong retail demand. As we look at the leasing activity, this is going to look a little different than the industrial market. Obviously, we haven't seen a huge rebound in leasing activity compared to what we saw in industrial. But you can see we did see a pretty big fall off in leasing activity pretty much across all Texas markets in 2020. We've rebounded some in these markets, but COVID really is the biggest sort of risk factor for retail. Obviously, as we saw some movement as a result of mandates being lifted in 2020. But the reality is when COVID cases rise, we see, generally speaking, in-store retail shopping dip. And so that obviously creates uncertainty in business confidence in committing to new space, expanding spaces, growing your business. But, one of the things that I think we actually have seen is that really leasing activity has mostly been constrained by the lack of space available more than anything else. Houston's vacancy, among all of the Texas markets, Houston's vacancy is the highest at 5.5% or so, but that's well below where the metro peaked during the great financial crisis. It is only 5.5% vacant in Houston, which is, really not that vacant when you think about it. If your occupancies are hovering around 95%, I'd say that's a pretty tight market when it comes to retail space, and that's a function of the lack of supply. But we'll talk about that in a second here. The other thing that I wanted to point out is, with the rebound in leasing activity, we actually have seen some of the strongest retail demand of any place in the country across Texas here. You look at those metros highlighted in blue, those are the Texas metros there. You see Austin and San Antonio as a percentage of their inventory. They're smaller markets, obviously, are showing up higher on the list. But you look at Houston with 5 million square feet of absorption over the last year, Dallas with 4.2 million square feet of absorption, Austin with about 2, and San Antonio also with about 2. Those are really strong numbers in the midst of a pandemic. And so of the places we're seeing retail bounce back fastest, we're seeing it here in Texas. Now, we do, as mentioned on the industrial front, we do typically build a fair amount here in Texas. But if you look, yes, we're building a lot relative to the broader country. But if you look at the axis at the bottom there, we're all of the markets, with the exception of Miami, are building less than 1% of their inventory today. And that's a result of strict lending standards and all sorts of other factors. But, the reality is, with really strong population growth, as we mentioned earlier, this is percentage growth of population between the two censuses. We see Austin, Houston, San Antonio, Dallas, and Houston all ranking within the top 5 or 6 spots in the nation in terms of percentage growth in population over the last decade. That's going to bring a lot of growth here to Texas, especially when you mix that in with the fact that we've seen really good recoveries in jobs for all of the Texas markets, with the exception of Houston. And I know the panel before me sort of speculated on the geopolitical crisis going on right now and what that might do to oil prices. And that obviously would result in a quicker bounce back for a place like Houston as well. Now, as we pull back and look sort of at the macro level here, those store closures we looked at the first slide in this section, really did weigh on absorption at the national level. But with the fewest stores closed on record in 2021, and at least in recent history, we see a pretty bright future for the retail market, especially considering the really high occupancies we have, not only here in Texas, but across the nation as well. You see on that chart there on the bottom left, we have vacancies that are hovering around the broader US number, but if the broader US occupancies are above 95%, it's really hard to sort of call out the decline or the death of retail as we know it. There's certainly bifurcations within the market. We've seen grocery perform really well. We've seen discount perform really well in particular. But, the reality is that most places are pretty well occupied thanks to that limited construction. Our strong population growth and economic growth here have obviously contributed to our faster bounce back than the broader nation. But like I said, the COVID variants remain the concern here. I know the numbers look good right now, but as soon as they start getting worse again, hopefully they don't, but if they do, that's when we start to see retailers pull back on space commitment plans, reopening, all those kinds of fun things that have really been the key story over the last 18 to 24 months. Now, as we transition to the office market, the story is pretty simple. We've seen a bounce back, much like we did in the retail market, in just about most places. Houston still lags, but again, we're hoping that comes back given where oil prices are and where they're expected to be. The biggest bounce back we've seen is in Austin, where I'm based here. We've seen a huge decline in sublease space. We've seen companies like Facebook open up or at least 600,000 square feet recently. TikTok is opening a new office here. Whereas in Dallas, we've really got growth across all industries. It's not one particular spot in the market that's doing exceptionally well. It's every place. And in Houston, we've seen mostly medical and energy leasing lately, which is sort of constraining the activity lately. But with sublease space, we're seeing that continue to kind of hang up in most markets across the country, with the exception of Austin. But the real story of the office market has really been this flight to quality. I know Peter will probably talk about this a little bit in his portion of this panel, but we've seen incredible demand for 4 and 5 star space. That's what we call Class A here at CoStar. 3 stars is effectively Class B, 1 and 2 stars kind of Class C. It's not a perfect proxy, but it's our way of analyzing the market. And you see that if we index it back to the beginning of 2015, all of the demand we've seen in Texas here has really been in the 4 and 5 star Class A space. One of the reasons for that is because that space is really an amenity for tenants. And one of the things we've seen is even with the rise in remote work, we're seeing that all of the Texas markets are adding the kinds of jobs that are typically going to an office every day. And that labor market was already tight before COVID. And so we benchmarked this back to the beginning of COVID back in February of 2020. And you look at Austin, San Antonio, and Dallas taking up some of the top spots in the nation when it comes to adding the kinds of jobs that typically generate office demand. And long term, this is going to drive the recovery. And if that labor market remains tight, this really becomes your differentiating factor. Do you want to go into an old building with poor ventilation in an era of COVID, or do you want to go into a nice building that's well certified, that's got all of the HEPA filtration systems and all of the bells and whistles that new buildings have? Clearly, if you're an employer, you're gonna go with the better space, because if you want to attract and retain that talent, you're going to need to offer them a differentiated experience. The other nice part about what we're seeing here in Texas, if you're a landlord at least, is in most markets, with the exception of Austin, we don't really see a whole lot of new supply. And so while vacancies are higher than they've been, driven by COVID and sublease space and also work from home and all of the other trends that I'm sure Peter will talk about, we really, from a fundamental standpoint, can't see the market getting a heck of a lot worse if you're outside of Austin. If you're in Austin, where you can see we've got the most supply of any market in the country as a percentage of our inventory, the market is a little bit more differentiated. There are other things happening. But again, if we go back to that leasing chart a few slides earlier, the bounce back that we've seen has been most apparent in a place like Austin. And so it's not to say that there might not be any troubles in a place like Austin, but there's also a lot of capital betting on the fact that Austin rebounds pretty quickly. And in fact, that's the same case across Texas. We've seen the investment activity pick up across Texas here as we expect the reopening to, or the rebound in the office market to really take hold here in Texas. It's a much more sort of culturally in office kind of state. We're seeing a lot more, the biggest rebound in some of the Castle Systems office occupancy data has been in Texas. And so when we start to think about, where the markets may recover the fastest, bet on the places with lots of economic growth, lots of population growth, and a culture that tends to go into the office every day, which is what we're seeing here in Texas. And so, when we look at some of the macro themes we're seeing across the office market, we're seeing that great rebound take effect here in Austin, whether it's from the office occupancy to the leasing activity to transaction activity. We're seeing that rebound in activity here in Texas. And that limited construction is one of the reasons why. Outside of Austin, we're looking at San Antonio, Dallas, and Houston. Those markets are seeing that rebound as well. And the fact that those markets aren't seeing as much construction activity as they have historically should mean that fundamentals continue to recover in those markets as we start to see absorption turn positive. The flight to quality, though, is really the overall story we're seeing. I know, Peter, I don't want to step on your toes, but this is really the main story in the office market. It's the Class A buildings have done exceptionally well. When we look at the vacancy table and the rent growth table, you see that our rent growth over the last year in 2021 was slightly higher than the broader national average. But we've turned positive, and that I think is the real indicator of the recovery beginning in the office market. We're not seeing landlords continue to slash rates across the country, especially not here in Texas, even with our vacancies that are much higher than the overall US average. And with that, I'll pass it back to Candace and Peter, and they'll talk about the changing dynamics in the office market that we're seeing.
What do you think of this, Peter? Is all of this sort of new to you, or are these things that you've sort of heard in your time covering all the workplace dynamics?
No, I think it's an excellent overview by Sam, and I was just in Austin last week for the entire week, so I witnessed personally, Sam, much of what you shared. So it resonates well, and I'll be glad to begin, Candace, with my session. If you folks can see my slide, Candace.
Yes, looks good to me.
Okay, let me just put it into slideshow view. So great overview from Sam, and I'll be taking us through the future of work and emerging real estate trends. As I said, I'm based here in New York, but I spend a lot of time nationally and internationally, certainly a lot of time in Texas and Dallas, Austin, Houston, and we have major clients in San Antonio. As per Candace's kind introduction, I've been with JLL for the past 15 years. I'm a former PwC advisory partner. I've helped to transform close to 1.5 billion square feet of corporate real estate. And I've also helped to develop 50 large corporate Fortune 100 headquarters. So we serve on a number of advisory boards, the Accenture Technology Vision Board, a number of academic advisory positions. And then my day job is supporting our Fortune 100 clients. And then I also helped our firm CEO and leadership with our own future of work initiatives and strategic initiatives. As Candace mentioned, we published a book last year with our CEO of the Americas, Head of Research, The Workplace You Need Now. It's a navigational guide to the future of work. It's an Amazon #1 bestseller, and glad to support those who are interested with the website and ordering the book as additional context. So I'll be taking us through some key trends from what we're seeing from a enterprise occupier perspective in particular, And these first 5 trends are pretty pervasive across all of our major client categories. We're working across financial services, telecom, technology, consumer products, industrial. So one of the key drivers today is the focus on talent and workplace experience. So as Sam mentioned, as we're seeing perhaps in Austin within the Texas marketplace, and also in Dallas and Houston, San Antonio, this need for digital talent and technology talent and technical talent today is a demand across all sectors. We are seeing post the pandemic, as we go through the pandemic, the need for these multidimensional hybrid workplace pilots. So hybrid being defined, people working in the office 2 to 3 days a week, 4 to 5 days a month, remote work, co-working, working in the metaverse, these diverse integrated workplace programs I'll share a little bit about today as to where hybrid is going and what we may see in the future. We're also seeing a great deal of investment into AI and integrated human to machine collaborative systems. So as AI comes to market and scales, these machine enabled collaborative robots that we will all be partnering with will also come into the workplace. And then we're doing a great deal of work in global behavioral change. So how do we change behaviors for employees and managers? As a manager, how do I manage a distributed team that may be hybrid of 2,000 to 3,000 folks? And how does the new behavioral change architecture, how does that get properly articulated and communicated and engaged across large organizations? And then finally, we are seeing some very interesting optimization. And as Sam mentioned, we're seeing a flight to quality from a portfolio perspective. Here in New York, for example, 80% of the transactional activity is occurring within 20% of the high quality envelope of 400 million square feet here in New York City. So portfolio transformation, workplace transformation are all underway, and I'll be sharing a little bit about how and why that is happening. So if we look at our research with Gartner, and this is a really important slide, which Gartner published in late 2021, we are migrating from an office-centric work design to a human-centric work design as the new enterprise priority. So historically, we designed work around locations, and we provided consistent work experiences. We were looking to enable serendipitous collaboration, and there was a great focus on visibility-based management of employees. All of that is starting to now transition to what Gartner terms as human-centric design, where the hybrid model is designing work around the individual. So we're looking to provide consumerized, personalized, individualized, flexible work experiences for all of our employees. We're looking at intentional digital workplace collaboration, which we'll speak to a bit about, and we're looking at empathy-based management. So managers need to lead and change and work differently. Employees are learning to work and lead and change differently. And so this entire new human-centric ecosystem is evolving. I'll have a couple of case studies that will highlight this. So this next slide represents some of our work with McKinsey. And what's fascinating about this slide, during the course of the pandemic, there's been a widening gap between what employees want and what employers want. So employees want to be valued by the organization, have a sense of belonging, and employers want greater loyalty and retention of employees. And as a result of the pandemic and the Great Resignation in 2021, over close to 30 million people resigned their positions. We're starting to see that this gap is actually widening between what employees want from the organization and what employers are willing to provide. And so we see this human-centric design and employee-centric focus as a means of perhaps meeting and mitigating this gap. We're also doing quite a bit of work, and I'll share a case study with digital talent and talent anywhere strategies, where some and many new workforce strategies are location agnostic. So I can't find all the technology talent I need in Silicon Valley. I'm going to look at a location agnostic talent strategy, a talent anywhere strategy to capture that talent. So a little bit about the physical envelope, and this slide represents the historical workplace envelope on the left and the new hybrid workplace envelope on the right. And within our firm, I have currently right now 75 hybrid workplace pilots underway with various large Fortune 100 organizations. And on the left, I'll just share from a from a headquarters perspective. We used to see a great deal of space allocated to individual space. 80, 90% was individual, 30, 40% might be collaborative, amenity, social learning. We're moving in a new direction on the right, which will require workplace technology investment, where the collaboration space may be 70, 80, even 90% of the envelope. And then the remainder of the envelope within a given building will be dedicated to amenities and social learning and some individual space allocation. So with the hybrid workplace transformation we're seeing, the office of the future will be a social hub. It'll be a place for communication, connection, collaboration, and creativity. People, employees may come into the work envelope on the right 2 to 3 days a week, 4 to 5 times a month, whatever that frequency is. And they're really looking for this peak experience in the next generation office as we move into this new hybrid world. So one key takeaway for hybrid that I'd like to share with the audience is that leading organizations will undertake intentional experimentation via piloting to enable diverse consumerized hybrid workplace behaviors to make hybrid work successful. So there's a great deal of experimentation underway at present, and from our client work with companies like Accenture, Microsoft, Procter & Gamble, many of our financial services clients, which I'll share in the case studies, we're seeing this need to experiment via piloting, determining what may work well, and then taking a learning mindset in terms of how the future of work is enabled within those organizations. So I'll take us through a few case studies here, and I hope you can all see the slide, pardon me. This is a global financial services firm, 100,000 person firm we've been working with for the last 7 years. And we began the hybrid workplace journey with the CEO, CFO, CHRO, CTO, and executive leadership team in mid-2020. And on the left represents the business drivers, the talent workforce requirements, the technology requirements, and hybrid workplace preferences we gathered as input. And then we put all of this together in the middle in terms of the workplace transformation models and pilots relative to the business drivers, talent strategies, change management, technology investments. And we have over 12 pilot programs underway within this 100,000 person organization that are looking to lead to what we see on the right relative to these future outcomes. So we're looking at new business outcomes, new HR policies and protocols. For this particular firm, we've purchased 20,000 new laptops to enable greater workplace mobility. And we're developing these hybrid workplace policies and programs with the CHRO, the head of human resources, with business unit leadership. And then we are co-creating in a regional sense, in some cases, and certainly in a business sense, how all of this hybrid work and hybrid workplace behavior will orchestrate itself. And per Sam's good statistics today from Castle Systems, due to the pandemic, we're seeing at most, even in Texas, 40 to 50% return to office. For this organization, they have some locations nationally that are less than 10% and others that are upwards of 40%. And as we go through 2022, we're looking to create this hybridization and new workplace program platform as a new way of working that's endorsed by their CEO, executive leadership team, and business unit leadership teams. This next example is from one of our global banking client. This client has over 350,000 employees, over 7,000 sites globally. We're working with this client and their executive team in banking for a customer-centric approach in terms of how they will deliver omni-channel banking, modular banking, open banking, and smart banking to their customers. We're taking a customer-centric approach for all over 300,000 employees on the right, where we're developing digital experience, digital workplace experience. We're looking at their global platform from a provisioning of digital services and workplace services. We have multiple hybrid pilots underway. We're looking at major investments in new workplace technology, including smart Internet of Things and connected technologies and contactless technologies within their next generation workplace. And then the whole evolution will become what we'll call a smart workplace envelope. And this human-centered, digitally enabled workplace for this global bank will be their new ways of working. We are reducing their overall real estate portfolio by about 30% globally. And per Sam's good data sets, we're looking at a flight to quality in many locations, moving from where they are today to higher quality locations for the future. The next case study I'll share is a global technology company. This is a 60,000 person organization. It is headquartered in San Francisco. It has 200 sites globally. This firm is very advanced and is taking a digital first, talent anywhere and workplace everywhere approach. So if we begin on the upper right quadrant, with their executive leadership team, CTO, business leaders, we're looking to digitize all the workflow across the organization. We're also looking at a digital workforce talent anywhere strategy where they'll keep the 200 locations that they have globally, but much of the new hiring of talent will be location agnostic. We've also helped them, which was published recently in the Wall Street Journal, develop a health and wellness ranch where employees will be brought in every quarter or every 6 months for a week for enculturation. And so this is a new way of developing corporate culture outside of the traditional office envelope. And then we're also developing digital workplace, new digital tools within the existing envelope of their 200 sites. And then we are optimizing the portfolio in certain locales where they may not need as much envelope as they had previously due to these new hybridized workplace behaviors. For this client, we have over 2,500 manager to employee agreements in place. And so the managers with their employees are understanding how do you wish to work, what days do you wish to come in, and that entire hybrid workplace architecture is being developed and refreshed as we speak. So I'll leave you with a couple of final thoughts here that in addition to the hybrid workplace and the digital workplace, the regenerative workplace is also a key area of focus. So looking at workforce preferences in terms of health and well-being to enhance human experience. The next generation of workforce is very concerned about health, wellness, well-being, and safety as a result of the pandemic. And so I'll share with you a final client case study. Again, major financial services firm. This firm has appointed a chief well-being and wellness officer who reports to the chief human resource officer. This executive, she's responsible for the mental health, the social health, and the physical health of the entire organization. And we as JLL have helped orchestrate the construct that you see on this slide, looking at everything from psychological safety to inclusion, to community belonging, shared responsibility, physical wellness, work-life harmony. I've put in probably several thousand corporate gyms into various corporate campuses. For this organization, we're looking at new meditative and mental health and wellness interventions. And the organization is really focused on these key core pillars of mental health, social health, and physical health in terms of how they enable their next generation of talent. And also, how do they address the cognitive fatigue and the PTSD that many of us within the workplace and workforce community have experienced over the last 2 years as a result of the COVID experience. So there's a great deal of focus investment today on mental health, social health, and physical health, and we're glad to share more about that as we move forward. So finally, in conclusion, these are the 4 pillars that we're seeing today from an occupier and enterprise workplace perspective. Organizations and leadership teams are looking to build community and connectivity both in person and virtually. We're doing quite a bit of work in the metaverse right now and extended reality and virtual reality. So not only in the physical space, but building community in the digital space. Well-being, as I just described, how do we develop a regenerative, holistic health and wellness for all of our people? From an inclusion perspective, from a diversity perspective, from a human performance perspective, and then from an experience perspective, how do we create these safe, engaging, and meaningful experiences to create peak experiences that will drive people back to the office? And this is a key challenge right now across many organizations in the post-pandemic world. And then finally, the pandemic was a wake-up call. And we're going to experience more pandemics, and we're going to experience more climate change events. So how do we develop resiliency in terms of agile, flexible, and resilient real estate and workplace portfolios in the future? And how does all of this tie together with cogency, with an integrated approach that will really enable, next levels of performance? And finally, along the bottom, these are key takeaways with all of our clients today, where we're looking to accelerate digital. We're assessing these new changing work styles. We're monitoring talent and workforce preferences, and we're taking a learning mindset from our work with Microsoft. I'll use the example, the Microsoft CEO has a mantra that he wants to be a learn-it-all organization versus a know-it-all organization. So we're taking a learning approach through testing, piloting, adaptation, and through all of this, we're creating a much richer, hopefully healthier, and higher performing environment for the future. So with that, I will pause and turn it back to our moderator, and glad to take Candace and team Sam, any questions?
Perfect. Well, Peter, thank you so much for that. That was so helpful. And my apologies for the audio issues earlier. I switched out headsets, so hopefully this one does a better job of capturing what I'm saying. I owe you both reintroductions at some point, but let's get through some of these questions first. First question goes to you, Peter. With all of your pilots, various models you've been experimenting with, what has been that net impact on total square footage on a company's real estate? I mean, you mentioned one of them was 30% reduction. What does that look like, and what are you seeing sort of across the board?
It's a great question, and I will answer it in a way that may not please this audience, but I'll answer it in the way that we're seeing the marketplace evolve. So I have clients that are actually taking 10 to 20, even 30% new space, per Sam's great, analysis in the flight to quality. So we're seeing, some of my technology clients in New York, London, San Francisco, Austin, they're actually taking new space and they're gaining space. At the same time, I have other clients that are reducing portfolios by as much as 10, 20, 30, even 50%. And there's no one size that fits all today. And for my technology clients and banking clients in particular, they're very concerned about digital talent, how to capture that talent. And so location matters and portfolio size matters to some degree, but the real driver is how to capture that next generation of talent. And is my real estate, and are my real estate locations, and are my workplace envelopes? I mean, Sam gave a great example. People don't want to come back to work to a 40-year-old space that's underperforming. They just don't. So, we have a saying at JLL, is your space commute worthy? What will drive people back to an office environment, engage them, create that dynamism, create that excitement? So there's both investment in new space, but there's clearly consolidation and rationalization of existing older space. And to Sam's comments earlier, we will see obsolescence of certain parts of portfolios and certain segments of the market over time. And that's occurring today in New York, San Francisco, London, and I'm sure Austin, Dallas, Houston is similar.
If I could jump in too and just add one piece to that. What we're seeing today on the work from home trend feels a lot more not necessarily about a fight back against the workplace per se. I think it's more a fight back against the commute, as Peter was pointing to earlier. Whether it's commute worthy is sort of the defining factor of, like, if you're going to get in your car and drive 30 minutes to and from work, if not longer, at least here in Texas, or if you're in New York or San Francisco, you're going to risk getting on public transportation to get to the office. It better be worth it.
Yeah, especially with the price of gas, Sam.
Right. Yeah, no kidding. Yeah, right now.
Right. We have another question that was wondering, Peter, if you could dive into what is social and learning space? Does this just mean it's a conference center, or what does that mean?
Yeah, great question. So the new amenitized social learning collaborative spaces, we're seeing, for instance, we have one client that's creating a virtual reality room that everyone can come into the office or learn via virtual reality at home or a co-working site. And so social engagement and social learning and virtual reality learning can occur in the office space. And we're seeing some very interesting new micro-learning trends that are occurring. And so how do we share knowledge? How do we collaborate in the physical environment? So back to Sam and the conversation we just had, if I'm going to come into the office, I want to collaborate, I want to connect, I want to be creative, and I want to learn. And again, that commute-worthy, purpose-filled driver back to the office. Then at the office, I'm going to need socialized, technology-enabled spaces that will help me learn. And it can't just be a bunch of tables with a few chairs and, you know, a whiteboard. So we're starting to see some new investments in digital toolkits, socialized learning, micro-learning, and the next generation of the workforce in particular, they want to learn, they want new skills. And so how do we create that both in the office, and also how do we create a transfer of knowledge? You know, I have several clients that are reaching these incredible retirement thresholds where they have 10 to 15 to 20% of their workforce retiring in the next 5 years. So how do we also create knowledge transfer either in the workplace through socialized learning or through digital means, again, through, you know, augmented reality, extended reality. So lots of focus today on learning and, you know, glad to share more on that. But that's sort of that amenitized learning and socialization space investment that we're starting to see across many organizations.
Very cool. And this is a question to both Sam and Peter. You know, we all know what's going on in the geopolitical world, and you know, we've got rising rates that we're having to be concerned about. How will these sort of two different news topics sort of impact real estate valuations and what might happen for property prices moving forward? Peter, Sam, I think this is more of a Sam question, but Peter, you're welcome to jump.
No,
you're
I'll let
welcome
Sam
to
go
jump
first.
in.
I'll build
Okay.
on Sam.
All right.
Our very real and absolutely does 100% exist crystal ball. I can tell you the exact answer for no. Anytime there is uncertainty in the world, what tends to happen is you tend to see liquidity dry up a bit. We saw that in some of the data that I was sharing earlier when it comes to transaction activity in 2020, where we saw a huge pullback across the board from real estate investors with pretty much everything except for apartment fell down a little bit, but has rebounded quite aggressively in 2021. But when it comes to real estate values, you know, when treasury rates rise, it's not typically a 1-to-1 ratio with treasury rates and cap rates. And so as a result, office and retail typically have higher yields than industrial and apartment do. And so industrial and apartment are much more exposed to that kind of risk than an office or retail asset would be. It's not to say that they won't be affected, but there's more cushion to absorb rising rates in an office investment or retail investment than there is in an industrial investment, which may be trading at a sub 4% cap rate, depending on asset location, et cetera, et cetera, et cetera. But you know, with high prices on those assets in particular, there is more yield risk there.
And I'll just add to Sam's good comments. I think, you know, Class A office, I don't want to say it's recession proof, but we're seeing in New York and elsewhere that the flight to quality will remain regardless of the economic uncertainty. And then logistics space, experiential retail, life science laboratory space, these segments seem very strong. And, you know, I'll just mention too, in Lower Manhattan post 2008, 20 million square feet was converted from office to residential over the course of 10 years. So we also are going to see some really interesting new mixed use conversions, I think, as we look at new urban patterns, new shopping patterns, new work behavioral patterns. So I think it's a very dynamic time given both the uncertainty and the transformational influencing factors underway.
And to that point, you know, we may see more office to residential conversion, but that's also very difficult to do. Typically speaking, office floor plates obviously weren't designed for residential use. It's pretty costly to redo turn an office building into an apartment building. I know 1401 Elm up in Dallas went through that process and had a few different owners because of some major asbestos issues and all sorts of other things that can come up as a result. It's turned into a very successful and very cool looking project now, but it can take a lot of work and a lot of capital to make that happen. And so you're probably not going to see a bunch of that early. That will probably take some time to kind of work its way through the system to kind of think about not only can the floor plates be converted to residential in a way that people would actually want to live in that building, but when it comes to environmental remediation and all sorts of other pieces to that puzzle, we may see that just take a little bit longer than people expect that to.
Mm-hmm. This is a question for Peter, Sam, whoever wants to answer it, but Shirley is asking, how do you reduce social isolation for those who are working remotely? What do you think, Sam, Peter? Do you want to weigh in?
Yeah, I'll go first on this one. I think, social interventions are really important. And I have several clients that have never shut down during the pandemic. And they've allowed certain segments of their employee population to come to the office who, for instance, work in very small apartments. I have clients in India where the electrical grid and the infrastructure support of the home environment doesn't really support home working. So I think the more enlightened clients have provided socialization opportunities in addition to the purely remote opportunities. And then as we move into the hybridized world, this is going to be the challenge because some people are extroverts and really enjoy 4 to 5 days in the office. Others are introverts and actually have fared really well during the course of the pandemic and would prefer not to be in an office in a social environment 4 to 5 days a week. So I think we're going to see, again, going back to our conversation in the presentation around consumerization, personalization, what's right for Candace needs to be right for Candace, what's right for Sam needs to be right for Sam. And how do we enable that in a way to mitigate, isolation, but also to enhance performance and flexibility and lifestyle choices and diversity and inclusion. We're really looking at diversity as a means of engaging new segments of the workforce through hybrid and, if you will, more remote collaborative engagement. So great question. And I think more interventions will be evolving as we go.
I think to Peter's point too, that he made earlier, building those, if you're going to the office 2 times a week, and the office is commute worthy, that also means not just the space has to look nice and feel nice. It means it also has to be productive for, if you're there for 2 days a week, the interactions that you're going to have with clients, fellow employees, bosses, those kinds of interactions, they'll need to have space that exists for that. And I think, in the diagrams you were sharing, sort of in the cube diagrams of, the individual space breakdown versus the collaborative space breakdown versus all the other ones. I thought that was really interesting when it comes to, sort of how folks are designing their spaces moving forward, because if they're going to try to, not necessarily force, social interventions, as it were, but create environments where that's all you're going to the office for, that then becomes its own sort of commute worthy space as a result of just having that there.
Yeah. And to add to that, Sam, if you think about the office of the future like a boutique hotel or almost like a resort collaborative socialization environment, and think about a really great retail experience or resort experience where you felt welcomed, you felt engaged, you felt you could be yourself, you had good services. I mean, these are the trend lines for the office of the future.
And it sounds nice. I mean, I want to go to a boutique hotel now and go kick back at a spa. That sounds wonderful, Peter. But Richard is asking, well, what can small businesses do to sort of compete in this new modern workforce environment? Because they may not have the capital to, do all these great things.
I'll go there. My answer is co-working. This weekend, the Financial Times had a great article about Canary Wharf in London that's offering amenitized landlord socialization boutique hotel space that I just described on the lower floors of Canary Wharf. And so if you're a small business, and I have several startups that I serve as an advisor to, none of them have office space. They don't have any dedicated office space. They are working through co-working. They're working through remote collaborative technologies. And so I actually think for the startup world and the mid-sized business world, it's a really exciting time where you may not need to make those major initial investments in dedicated space. And digital collaboration, co-working space, some of these more creative, opportunities are now available at scale that weren't available 10 years ago.
And I think to your point too, about those folks that don't have, maybe in-person spaces, it's a lot cheaper, if you're not paying for office space for a whole, 5-year lease or what have you, it becomes pretty inexpensive to maybe, have an in-person collaboration meeting once a month where you either go on, retreat, as it were, as a company for a year or what have you, where the offset costs of not spending the money on the real estate space can enable deeper and more connective time together in a space that's not necessarily the space that you're spending every day, all day long in.
That's right.
We have a
Maybe
question.
You go to those books, you go tell us. Sorry.
No worries. So we have a question from Lynn talking about data on education. They're asking, what is the impact of this migration that we're all seeing? We're all talking about this war on talent and how people are using office space to sort of get this talent. But how key is education, and does it really matter where people get an education, or are you guys seeing migration all over the place? I mean, if Texas, let's say, starts investing more money into higher education, does that help out Texas? Or I don't know. Peter, Sam, do either of you want to comment on this?
I mean, I'll comment that we're working with several large public school systems at the moment and several universities. And so this same sort of digital enablement that we're seeing in the enterprise workplace is coming into the educational workspace and workplace and educational social learning platforms that are evolving. So lifelong learning is now a given. And the ability to learn these new social skills and new engagement skills and critical problem solving skills couldn't be more important than ever. I don't know if some of our traditional educational systems serve that well yet. So I do see, again, as we're seeing in the office, workplace, corporate workplace transformation, a similar transformation in academia and higher education learning, and actually even across all sectors of learning. So great question, and glad to provide follow-up if helpful. Sam?
Sam, did you want to add to that?
No, I think you covered it.
Peter can be hard to follow up to, can't he? Some people are asking also, Peter, does JLL have white papers of all this data and information that you can share with them at a later date or online?
Yes, we definitely have white papers through our research groups, and glad to share that, Candace, through you or the Federal Reserve.
Perfect.
If they wish to follow up. Absolutely.
Well, I think we have gone over and then some, but I definitely appreciate Peter and Sam. Just a reminder for those people who were here earlier and may have heard my mic cut out quite a bit. Sam is the Director of Analytics and Market Economist, specializing in market research and economics for CoStar, the world's largest commercial real estate and data and analytics firm. He's based in Austin. He covers research for Central Texas. Peter is the Managing Director of JLL Strategy and Innovation Practice. He's based out of New York, and he's also co-author of The Workplace You Need Now, which is an Amazon #1 bestseller. It's also fairly hot off the presses, published in November of 2021. So if you have additional questions, please reach out to these fine gentlemen. Definitely could continue this conversation, but we're going to have to reel it in at some point. So thank you guys so much. I believe this concludes the day. Please join us tomorrow. We're looking forward to hearing more about, and then I'm also having a please post contact information. We'll see if the Dallas Fed can do that so that you guys can get contacts from folks. But thank you guys so much. We look forward to hearing more panelists and speakers tomorrow. But yeah, stay warm. It is snowing in Dallas. It's kind of crazy, but
wow.
Yeah, I know Peter's like, wow, it is.
It is. Snowing here tomorrow in New York. So thank you, Candace. Thank you, Sam, so much.
Thanks, everybody.
Thank you. Take care. Bye, y'all.
Bye-bye now.